friends, today we're going to talk about asset held for sale. What is a held for sale asset? A held for sale asset is an asset which the company believes that the carrying value of that asset would now be recovered by selling that asset into the market, and it's not going to be used in our continuing operations like our day-to-day operations. So once the company has made a decision to dispose or sell off an asset, we need to make sure that it is accounted and recorded accordingly. Thus, we have certain guidelines and criterion as to how you are going to record an asset held for sale and when it becomes possible, on what conditions and criterion you should look out for to classify an asset held for sale. So whenever you see in cases like there could be as straight as closure of a division or selling this asset in exchange of probably a better asset. So this is also a trigger that would tell you that you have to apply asset held for sale criterion there. Or it could be like a case which is a live case where a company is thinking that this particular storage house is not sufficient to store our excess capacity, so we should rather go and look out for other options in the market for a better storage warehouse or godown. So in that case, it triggers that you now have to apply asset held for sale in that closure, or you have to now categorize that assets, that warehouse or that building as held for sale. So when I say so, the classification for asset held for sale must meet the following conditions. The first condition is that the sale must be possible in the present condition. The terms of the sale should be usual and customary, and there is a high probability that the sale would take place. So when I say it is highly probable, there are 5 conditions which would tell you that yes, the asset is probable to be sold. The first one is management is committed to sell the assets or the disposal group. And there's an active program to locate the buyer for that asset. The asset is actively marketed in the price, and the price that you're looking for is, closer to the fair market value, the sale price. Then the sale should be expected to qualify as completed sale within 1 year of its date of classification. And if the sales takes longer than a year, then it is beyond the entity's control and these conditions can be waived. So the actions required to complete the plan indicate that there is no likeliness that the management would not do or would not follow the pattern for selling that asset. So there is an assurance that the sale would take place. So once all these 3+5 criterions have been followed and conditions have been met, you can classify the asset as held for sale. So your first point is classification. Then how do you classify? How are you going to measure this asset? So this asset would always be measured at your cost or fair value less cost of sales, your carrying value or fair value less cost of sales. The lower of the two, you're going to recognize the asset. And any loss on the sale of asset which was held for sale is recognized in your P&L, and you charge depreciation to the point that the asset is going to be classified as held for sale. Once it is classified, you don't charge depreciation going forward. If the fair value less cost of selling increase down the line, so whatever loss you have booked before, you're going to reverse that, and the net you will adjust the asset held for sale, right? And it is shown separately under other assets on the balance sheet. Coming back to now closure of a particular division or selling out a particular division, it could be packaging division, it could be marketing division. When a company makes such a call, again asset held for sale and discontinued operations apply. Now a discontinued operations is a component of an entity that is either being disposed of or is classified as held for sale. So in that case, you have to see again whether it is a separate major line of business that we are closing down, or it is a part of a single coordinated plan to dispose a separate major line of business, or there was a subsidiary that was acquired for the sole purpose of reselling. So when you see that, okay, this is one particular area which fits these criterion, then you see that this is a discontinued operations, and then you'll see whether it has been disposed of already or it has to be classified as held for sale. Then you will again follow that 3+5 criterion. 3+5 criterion should be like 3 when I say it's the sale is usual and customary, it's saleable in the present condition, and it is highly probability. And with the third point comes the 5 points that gives you an indication, yes, that sale is highly probable. And the difference under IFRS and ASPE is that the criterion for asset held for sale do not apply to distribution of those assets to the owners under ASPE. But if after the asset is classified as held for sale and the fair market value increases, like we said, that we will we'll bring up the impairment loss, nullify it, and then we'll adjust the asset. But under ASPE, once it is written down, you do not reverse it. I'll just read the correct words. If after the asset is classified as held for sale, the fair value less cost to sell subsequently increases, the reversal of the previous write-down is limited to the losses that have incurred since the asset has been classified as held for sale. That is, the impairment losses while the asset was in use cannot be reversed under ASPE, but in the IFRS you can reverse them. And non-current assets are classified as current assets if they are sold prior to the completion of your financial statements. IFRS does not address this, but it is more or less the same thing. I mean, that's what would happen if it is sold prior to the date of your closure of your financial statements. So that was all on the technical part. Coming to the cases now, I told you a scenario where there is a case of closure of a particular division, packaging division, assembly line, or something like that. So that is again a clear-cut indication, a clear-cut trigger that you have to apply asset held for sale or discontinued operations criterion. And if it's not so, it could be a scenario where, you know, they can say we are actively looking for a buyer for this particular asset and it needs to be sold. We're thinking about getting another asset in the place because this does not is not able to do the needful or fulfill the requirement of the business. So these are all your triggers in the cases, and again you have to follow these criteria that I mentioned, and then you will say that we will record it at carrying value or fair value less cost of sales, and after that you will say that under the balance sheet it would be recognized separately from the assets, and even in your P&L it will be recorded separately. So that was everything on asset held for sale. Hope you like it. Please like and subscribe the channel in case you want more videos to be informed about as and when I upload. Thank you.